Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here on the mic. We are in the month of June. 5 months, the calendar year is absolutely gone. And we have the Fed coming up next week with some more noise to shout out to the marketplace regarding interest rates and their outlook on the economy and so forth. So I don't know. How's your summer been going so far, buddy?
I mean, it's good. I'm certainly waiting to see what the Fed breaks next.
Yeah.
I got my own little office pool on that, kind of like March Madness. And ever since that tournament ended, I have been looking to gamble my money.
Well, there you go. I mean, you can definitely do all kinds of things with that. Over-unders.
Yeah.
How many times he says the words disinflation or inflation, all kinds of things
right.
can go on there.
The word sticky.
Right.
Yeah, you're like, yeah, it is pretty muggy out
No
in
joke.
this part of the country.
Absolutely. So we'll get to all those topics today, but obviously we got to chat very briefly here about a couple things. Number one, NBA Finals. And
Please.
Last night, little small event with myself, president of Shepherd Wealth Management, John Ashcroft, and my wife, Nicole, went to the Reds game last night, and they called up this kid, Ellie De La Cruz. Awesome.
Yeah.
Awesome. Reds' best prospect, maybe one of the best prospects in all of baseball.
Oh, wow.
Goes deep last night for the first time, 2-run homer, hits a triple, Reds win, bottom of the ninth, 2 out, 2-run homer. It was just an awesome game. Super cool experience. Haven't been to a game in years.
Right.
And that was a good one. That was a good one.
Yeah. I mean, I think maybe the last game I went to was with you last summer, 2 summers ago. I can't remember.
Yeah, that's probably the last one I went to. Yeah.
I've been fortunate enough to have been not as many ballparks as some aficionados, but I've been to I think 4 or 5 major league parks, and I don't mean to sound like a homer, but Great American is my favorite.
It's pretty great.
I love the old riverfront. I grew up as a kid going there with my dad, and that was pretty fun. Went to like 4 or 5 opening days in a row. My mom would let me off school.
Yeah, and the best part about the game, not only did they win in dramatic fashion, you got to see this new rookie play, but they got a bunch of young guys out there playing really, really, really good baseball right now. They're just a few games out of first place. They beat the Dodgers 2 games in a row.
Who was pitching for the Dodgers last night?
Noah Syndergaard started, but he got rocked.
Yeah, he's having a rough year.
Definitely rough year. And after the awesome win, we got to go walk right across the street to the Holy Grail. And I noticed that the Game 3 of the NBA Finals was on. So I was like, dude, we got to hop in here and catch the last quarter and a half. And, of course, Denver wins in Miami.
Yeah.
Joker goes off.
Jamal Murray went off. Did you see the stat this morning, the triple-double?
Yeah, both of them.
Yeah, first time in NBA history in any game that a duo had a 30-point triple-double.
Yeah, and in Cincinnati, hometown, right? This is where I'm from. Buzzing last night.
Really?
Like the Banks was buzzing on Wednesday night?
Yeah.
I mean, it was cool to see, man. Like
that is good to see, especially after the last few years,
Yeah. Like I remember when a kid growing up, like none of that stuff, first of all, wasn't even there.
Right.
And nobody wanted to hang out really downtown anyway. It just wasn't all that great and nice.
Yeah, I feel like both the Louisville and Cincinnati downtowns, or at least, kind of surrounding areas, have benefited from some, I don't want to say revitalization because, they were booming then they weren't, but it wasn't really a place where you went to go hang out. I can, especially for the Louisville downtown, I mean, it was all these weird junkyards. Yeah. Like after, something that crept up in the 80s, like you just didn't even do business down there.
Cincinnati's getting cool, man. I think it has a lot to do with the 2 sports franchises. Obviously the Bengals, Joe Burrow, he was at the game last night, actually. I obviously didn't get to hang out with Joe Burrow, but which would have been amazing.
Joe, if you're watching the live show,
he got to take batting practice.
Become an SWM client. You can get tickets like Joshua did.
They showed him on ESPN this morning. The Reds let him take batting practice, and he hit a homer in batting practice.
Oh, wow.
Yeah. And
wow.
And obviously he was watching the game somewhere where I wasn't. But anyway, awesome. Had a great time. It's been a great week for us, too, at Shepherd Wealth Management. We did a seminar on Tuesday night, Montgomery and Boathouse, right on the river there. Packed the room. More people showed up than what we originally thought, so we had to get some extra tables and chairs out there. I got to present, and I just had an amazing time doing that. I basically got to condense everything that we've talked about on this podcast, I'd say over the last 12 months, into 30 minutes. And it was great. A lot of questions, a lot of current clients that were there with some prospective clients, and Obviously we have video evidence of all the things that I'm talking about, as well as written documents with the newsletters and so forth.
Right.
But it was really cool to see current clients there being like, yeah, this is real. The service these guys provide, the results that they've been able to produce is really, really fantastic and really hard to compete with. There's really not that many other places out there that are able to do or willing to do, all the things that we're willing to do for our customers. So it was awesome. It's just been a really good week, and now we get to do this. So
yeah,
pretty pumped.
I'm pumped too. I love coming in here and hanging out with you and discussing finance, as the French say.
I'm not French.
Neither. Really far from it.
Not.
I've been there. It's awesome.
Yeah, well, I'd like to go on the to-do list. But
awesome for vacation. Getting
into today's topics, number one thing that we can cross off the list. So I've been talking, a long time about interest rates and the Federal Reserve, because that's the only thing that you're going to see on the news. It's the only thing you're seeing right now. It's on the cover of Barron's as well. But one thing we can cross off our list of stuff to talk about, at least for a couple years, is this debt ceiling thing that's gone. I know we got a lot of questions, not just from the show when we talked about it last couple weeks ago, about the debt ceiling and whether or not they're going to get it done in time and all this other stuff. A lot of questions from that show, and leading up to that show, plenty of questions from clients and even people just asking me in general, walking around that know me and aren't current clients. Say, hey man, are they actually going to get this done this time? Because it feels so divided on both sides. It doesn't feel like they're going to get this deal done to raise the debt ceiling and avoid default.
Yeah.
And all we really kind of hinged our hat on was what history had to say, which is what we always come back to on the show. What is the historical precedent for this? And the bottom line is, for that specific topic, regardless of how divided both sides might be in Washington, self-preservation is a very powerful motivator.
Yeah. I mean, we correctly might say, and I don't know how anyone can see it otherwise, but it's just such a manufactured game of some weird pickleball.
It's just leverage, man.
That's it. It's just totally for show for the voters.
Yeah, it's leverage. It's a dog and pony show a little bit.
They need to just eliminate the debt ceiling. I mean, even Buffett, the patron saint of our podcast, who, by the way, I want to tell everyone, has no affiliation with the podcast or SWN.
Not yet.
But just like Joe Burrow, we got him he's high on the want list.
No doubt.
But even Buffett talks about how it's ridiculous and they should just dissolve it. It does nothing but cause strife and fear-mongering, and it just erodes people's trust in the ability of the government to get something done. Because that has dominated the to-do list of everyone in the legislature, in the federal legislature for, a month?
Yeah, at least.
And nothing else has really been getting done. So,
I'm crossing debt ceiling off my talking list here.
Good. So we're putting that to bed.
The problem is we're still talking about the Fed and interest rates. Like, I am so almost done talking about this. I can't wait to not talk about it when this is no longer, the thing that keeps people up at night from a fear standpoint with their portfolio. But we're going to talk about it because we have to, and that's what the headline news is still, and rightfully so. And I know we keep talking about like this is a Super Bowl event.
Yeah,
it always is, because it has so many implications on what we're doing right now for customers. But also what we might have to do differently depending on what he says more than actually what he does. So the Fed meeting is next week. It's on Wednesday, June 14th at 2:00. We'll get the rate decision, and we'll talk more about that here in just a second. But at 2:30, we get the press conference from Fed Chairman Jerome Powell. But leading up to that, Super Bowl event is the day before, which I think is going to dictate a lot about what happens the very next day when Jerome Powell talks. So CPI, this inflation print, that's Tuesday, June 13th. We'll get that in the morning at 8:30. And just so everybody knows what we're looking at here, the core CPI, which is the Fed's favorite measure of inflation, it previously came in at 0.4%. So that was 0.4%. And anything lower than that or in line with that, really good.
Good.
You don't want to see anything above that number. I don't think we will. We'll talk a little bit about that today as well. And then they're looking at two other metrics that are also equally as important. CPI year over year, right? So that 0.4 number was month over month. So anything in line or lower is good. Year over year, anything at or below. I think we went below 4.9. 4.9 was the previous read, so want to keep seeing that go down.
Yeah.
And then last but not least, the core CPI year over year previously was 5.5. So again, anything lower than that would be a really good indication that the Fed is going to pause. And that's kind of where we want to begin today's conversation, I think, is because a lot of people still are uncertain whether or not the Fed is going to increase rates or whether they will, do what they call a skip. All that simply means if they do a, quote, skip, he'll say, hey, guys, we've increased interest rates more than 500 basis points. We did a lot of that in a very short window period of time, faster than really any other time in history other than when Volcker jacked up rates to 20% back in the 80s when we had hyperinflation. So he's going to say, we've done a lot of work already, and inflation has been trending in the right direction, not as fast of a decline as we'd like to, but because of the potential credit crunch that happened when Silicon Valley Bank went under, it makes some sense for us to skip this meeting as far as increasing rates, keeping them the same, but we just want to consume more data to see what the actual lag effect is on all these interest rate increases and how it's affecting the economy. So he's going to have a lot of cover for that, unless that CPI print the day before comes in hot.
What do you think? Do you think it's going to come in hot?
No, absolutely not. So we'll talk a little bit about that, actually, I guess, right now. So inflation, in our view, peaked in June of last year, where we had that 9.1% reading. It's been coming down, ever since. Now, very, very recently, as of the last two prints for CPI, it's still coming down. It's just, again, it's not coming down as fast as what some people had hoped. And even myself, I thought inflation would fall a little faster. But these lag effects and things like, first of all, financial services, they're showing a small inflation increase in financial services, and that has a direct correlation with the Fed increasing interest rates.
Yeah.
So that in and of itself, them increasing rates, causes a bit of inflation from a financial services perspective. So there's a lot of things. Used car prices, they had a pop. They're coming back down. That was talked about, very heavily in the news here recently. So no, I don't think inflation's coming in hot. I personally, just as a consumer and a business owner, the only real thing that I see a ton of inflation in is leisure things like flights, hotels, sort of stuff. That has a pretty high price right now, and I don't think it's changing anytime soon because the consumers are willing to do that. They may be willing to trade down on staple products like cereal, bread, milk, stuff like that. But it seems to me, based on the data that we're looking at here, is people would rather trade down on those staple things, but not trade down on an experience. And I think it had a lot to do with the pandemic, too.
I was just going to say that. Yeah, I mean, that's just a really luck of the draw for that for the travel industry. I don't know if that's exactly what you call it, but for airlines and hotels and things like that, is that people are just so fed up of staying home that they're going to be like you said, I'll buy these knockoff Lucky Charms.
They're good too.
The Lucky Chims, if it means that I can still go to my beach vacation, and not have to worry about that.
Yeah, I understand that, because the one thing that you can say that for sure is true, just as a human being, is like when you're older, you're not going to talk about the better version of Lucky Charms you got to eat and you were fortunate to have. You're going to talk about the cool experiences that you got to go do and places you saw and people you met and family you came with you.
Yeah, I mean, if you're not a greedy jerk, 100%, that's how you're going to view life. And I don't think most people would gladly take that. And I just want to say for everybody listening, I'm totally advocating for people to eat healthy.
Yeah.
Don't buy Lucky Charms, period. But
when you do.
When you do. Make it count.
Yeah. Get a healthy pour in there.
Yeah.
And so talking about inflation, I think we have to talk about these two things, side by side, because inflation, drives a lot of fear and a lot of emotions. Mm-hmm. Excuse me. So in my view, and I'm going to kind of give everybody a small snippet of some of the things we talked about in our seminar.
Yeah.
But you can also, by the way, go to shepherdwm.com, our website. It'll take you right to our newsletters that we've been posting. It'll take you right to our Friday blog. So every Friday I write a little blog. It'll also take you right to our YouTube and Spotify channels if you want to, catch the podcast. which we'd love you to subscribe. That way you're notified, every time we do one of these things, and certainly appreciate the support.
Yeah.
But I think the two things we got to kind of talk about here in tandem with inflation, because it drives all these emotions, there is so much gloom and doom still yet in the market. And the S&P 500 is up 12% year to date. The NASDAQ's up like 26.5%. How in the world can the consensus be right? So here's what we talked a little bit about, and we'll tie in all this inflation stuff that's coming up next week as well. So can consensus really be right if we have a trifecta of bearishness on sell-side strategists, which is all the smart institutional money?
Yeah.
Then you have retail investors themselves. And then you have, of course, the big institutional investors, the mutual funds, the hedge funds, the pension, fund managers and stuff like that. All of them are bearish. And we're going to talk about some of that data here in a second. Even after S&P is up 12%. So here we go. The sell side bearishness might be the most extreme that's ever been seen, at least in the last 30 years, based on the data. And considering that at the end of 2022, there were only 2 strategists on Wall Street that saw the S&P 500 exceeding 4,300 in 2023. And by the way, we only started the year on the S&P 500 right around, I want to say 4,100. I'm going to pull that data point up here real quick, Ez. I don't think you had that one off the top of your head today.
No, I want to say it was 41 though.
No, we were wrong. It was like 3,800.
Oh, wow. Oh, that's why the 4,160 you predicted was...
Yeah, that was a prediction by the end of April. We're going to hit 4,200. So I was a little short of that, but pretty dang close for sure. But yeah, so going back to the note here, there were only 2 strategists on Wall Street that saw the S&P 500 exceeding 4,300. Now, again, we started the year at 3,800. So that increase is a decent gain if you go from 3,800 to 4,300. But there's only 2 of them. Deutsche Bank had the S&P at 4,300, and this company called Fundstrat, who's led by Tom Lee. He's a CFA, former JP Morgan analyst, and a guy I deeply respect. I love his research and the work that they do, but they had the S&P, they called for 4,750.
Oh, wow.
And clearly the market's trending more towards that outlook that he predicted. And I have very strong feelings that he's probably going to be pretty fairly accurate, unless some black swan event happens out of nowhere where we're in direct war with some other large nation, which always is a risk. Okay, I understand that that's a possibility, but guys, if something like that happens into the world, first of all, history would have to say that when these events happen, like war, it's actually been a really beneficial thing from an economic and productivity standpoint. You can go back to all the conflicts that we've had and the results that happened after that. Nobody likes the conflict, obviously. Nobody wants to go to war, obviously, but history would say that. And the last thing is, if you're talking about, end of days kind of stuff, it's not going to matter how much money you have or don't have, or what the Fed's going to do with interest rates.
Yeah,
so
if it all blows up to where the dollar's useless, it doesn't matter where you park it. It's useless.
Go get the Lunky Charms, man.
Yeah.
Eat them.
Eat them.
Yeah.
Just hoover that whole box.
So let's get past that. All right. For all those people that want to talk about that, that's a risk. I understand it's a risk, but
it's always a risk.
It always is a risk. All right. So getting back to these, only 2 strategists that saw the S&P 500 having a good year. Everybody else said it was going to be a bad year again. But even after 5 months of gains and 9 price target changes, these are the smart money people changing their price target. Only 5 strategists at this point see the S&P 500 closing above 4,300. We're right freaking there right now. We're like at 4,280 on the S&P. But even after all this, only 5 strategists see the S&P closing above 4,300 by the end of this year, which is nuts. So think about this. Even after strategists chase equities higher, 15 of 20 are still calling for markets to finish the year lower from where we started the year at 3,800. And I am not trying to, malign the sell side strategist, but, kind of keep in mind consensus conclusions on sell side are largely priced in. And if they are collectively bearish, the factors they cite are largely baked into the price. Everybody understands what the real risk of the market is. It's the Federal Reserve and whether or not they're going to continue to increase interest rates, and the fear of them continuing to increase interest rates without allowing the rate increases they've already done to take hold and effect across the entire 11 sectors of the S&P 500 if they don't allow for more data to be consumed to determine whether or not they should increase rates, keep them the same, potentially cut them at some point in time in the future, then that is the fear that you're just going to keep jacking rates up and causing a recession that could otherwise be avoided. That is a real fear. But the key events in the next 4 weeks remain the Fed's June meeting. We just talked about that. A lot of consensus is kind of conflicted here on a dovish pause, like we talked about. My expectation is if CPI comes in lighter than expectations, then it's a great reason for them to consider just skipping this meeting, coming back a month later with more data, more jobs information, more inflation information, and then you can make another determination, like, do we need to do anything or not? And if it's not, then great. We can keep skipping this thing as far down the road as we want to. That opportunity to increase rates is still there. And as long as you give a good heads up, which I think the one thing that we can all agree on, I think, with the Fed and Jerome Powell, is they kind of do a good job of messaging what they're likely to do, in these upcoming meetings. They won't give you too much information. He's not going to make a prediction that, we're going to end up cutting rates. You're never going to hear those words coming out of his mouth for sure. They're going to keep asking these dumb questions, but he's not going to give you anything. He's going to say, we're a meeting to meeting, type of group here. But I do think he's going to talk very hawkishly. So I think you're going to get the skip. And I think he's going to say those things he has to say, but he's going to still hit the table and say, if inflation is not trending into that 2% long-term target that we're going for, we're going to keep at it. That's what you're going to hear. That's at least my guess anyway. We'll all find out together next week for sure. And effectively, 75% of consensus has a probability that a July hike will happen. So we might get this skip in June. They come back, and most people think, at least in the market, based on the data that we have here, they think that the Fed will increase rates at least by a 75% probability in July. Oh. So all this is baked into the market, like we're talking about here.
Yeah.
These are not like this is not a news event. We need the data. That's what is the anticipation in the news. Is like, all right, we got this coming. What are the numbers going to be? How the Fed going to react? Like, that's all you're hearing in the news right now, and that's all you're likely to hear between now and the actual news breaking event, which is Tuesday and Wednesday.
Yeah.
So that's why we have to continue to talk about all this stuff. But we still have some more information to cover here. So we do have 3 incoming data points that, in my view, would support the Fed to lean towards a potential dovish hike, right? So I'm trying to play both devil's advocate and data dependent person that I typically am. I think there is a possibility for what we would call a dovish hike, and I'll lay it out here for you. So first of all, the ISM May services prices paid coming in at 56. That's the lowest in 24 months, and that actually is a leading indicator that leads CPI data by 6 months. Mm-hmm. It also suggests that CPI could fall to that 3-ish% target before year end. The New York Fed paper shows persistent inflation is down to 3.6% in April versus 4.5% in March. And the Fed funds at 5% is a very tight against this. And the Minneapolis Fed comments suggest the Fed might change inflation targets in 2025. So all this to say that it is a 50-50 call probably, right? Coming into next week, I can make an argument one way or another that we should potentially consider increasing rates, but there's other data points that lead the CPI data that would tell you that maybe it doesn't make any sense to increase interest rates. Clearly, I do not want any more interest rate increases. I didn't want the 2 that we got already this year.
Right.
But I was wrong about both of those, and I thought for sure I was right because after the bank collapse, I'm like, there is no way they're coming in.
With the cojones to do it.
But they had the cojones, man. They did it. And that shocked the hell out of me and I think a lot of the market. But the market is super resilient.
Yeah.
In the face of all this stuff, in the face of the majority of the quote-unquote smart money saying the market is going to be worse even in 2022. And I got some cool stats here for you, and this is some of the stuff we talked about. So we already talked about all the smart money investors. Let's talk about the retail investors. So retail is everybody that's listening to this. If you're not a hedge fund manager, if you don't manage a mutual fund or pension fund or private wealth funds for, kings and so forth, you're a retail investor, All right, let's just define that real quick. So an interesting JP Morgan survey, I talked about this in the seminar event we did this week. So the same question was asked to retail investors. JP Morgan was just like, hey guys, all the institutions think this. What do you think about it? Where's the S&P going to be? Where's your price target for the S&P by the end of 2023? Here's the stats. 1 in 7 of retail investors thought the S&P would be below 3,500.
Wow.
Now, again, that list of 20-something institutional strategists, sell-side strategists, I mean, these are JP Morgan, Citigroup, UBS, you name the big bank. These guys had a target for it. And there was only 2 of them that had, actual decent positive results for the S&P. All of them else were bearish.
Yeah. The
lowest price point on that institutional outlook, this is January 2023. They were calling for the S&P to be at 3,400. Like, that was the lowest. So it's not surprising to me to see the retail investor, which watches the news, by the way. It's not like they're able to call a pension fund manager and say, hey, Bob, what's your opinion on the S&P this year? Right? They have to get this stuff from the news.
Right.
Or Barron's or something. So they see that, and it's not surprising to me that 1 in 7 people would say, yeah, smart money's probably right. S&P's going down below 3,500. But even worse, 54.7% of retail investors said that the S&P would be at 3,500. So if you combined the 13.7 with that 54%, 70% of retail investors thought the S&P 500 would be at 3,500 or lower for 2023. How wrong are those guys? And what do? What do you do when you get that kind of news and you think the smart money's right? Institutional fund managers over $3 billion piled into cash. And this says as of the beginning of the year. It's been more than that recently.
Wow.
What did the retail investor do at the beginning of January? Piled into cash, $1.5 billion worth. Again, this is at the beginning of 2023, right? Because they're seeing all this news. They're hearing all the institutionals saying the market's going to be awful. The fear and greed index.
Way up to fear, huh?
Lower. This is January 12th, 2023. The fear in the market was lower than what it was in 2008 and 2009.
Wow.
Like, I'm sitting there in this room and I'm sharing all this, showing it to them, like putting it right in their face. I'm like, guys, you remember 2008 was the worst thing that's happened in the market since 1929 when there were bread lines in this country.
Yeah. And
there's more fear now. Why is that? We have access to more information. So I'm showing them all these headlines. 55% of CEOs say the recession is going to be worse than the great financial crisis.
Oh, God.
And that was written January 11th, 2023. That was a Fortune magazine article. You got all these newspaper articles from the Wall Street Journal, 40-year high inflation, the Fed's jacking up rates faster than they ever have historically, global stock market slumps because of the Ukraine crisis. Forbes has this massive article in the news that says the stock market crash of 2023 in a question mark. There's a news article as well, well-known publication, that said sentiments turned more bearish in the last month. This is at the beginning of the year. Consensus is unanimous that earnings will continue to fall and the Fed has hiked sufficiently to lead the U.S. economy into a coming recession. This is the reason why we do this show.
Yeah.
Is because I know for sure the market's made up of human beings, right?
It is.
Human beings are hardwired with fear and greed, going back to caveman days. That hasn't left us. And if you understand anything about behavioral finance, or if you just watch the show, you don't have to read any books about behavioral finance because we talk about it all the time. We know that human beings feel losses twice as much as they feel good about making money. The news does a good job of playing into those emotions of fear and greed. And that study of behavioral finance is just a way of explaining how human beings make decisions with their money under stressful circumstances. And obviously you guys were stressed out when you looked at all this news, piling into cash, just going with the herd. Usually when everyone is on one side of a boat, it's usually a good idea just to either hop off that boat or go to the other side.
Yeah.
Right? Because you're almost always wrong. And that's the case this year. And the last thing, if I had a mic at this seminar, I could have dropped it after this last one. So I go through all that. The very first newsletter I sent out to investors on January, the first week of January, the very first thing I'm talking about here, quote, I will make a case that 2022 crisis is now shifted into opportunities in 2023, creating the highest probability of a plus 10% return since 2020. Our 4 top sectors going into 2023 that we like: technology, energy, industrials, and healthcare, in that order. And that was the opposite of what all the quote-unquote smart money said you should do. They were all piling into cash and the stuff that worked last year: staples, utilities, very conservative. Clearly, you guys were wrong, and it wasn't because I'm the smartest guy in the room. I am not. I'm a guy that's willing to understand the human being, and that makes up the market. And if I understand the human being and the simple fact that human beings just refuse to learn from history, as Warren Buffett would say, this is why this show exists, is we want to tell you what happened historically, because nobody else seems to care to do that.
No, they don't. And keep going.
It's frustrating. It's so frustrating. But I told everyone in the audience, I'm like, this information is available to all of you.
Everyone.
All right, just exercising. I don't like to run, but I do go run. I know that you run too, Ez.
I do. I'm the other way. I don't like lifting weights, but I try to do it. But I like to run. So everybody's got their own preference.
Right. I make myself run for all the obvious health reasons, but it also is like, mentally good for me, kind of clearing my head.
Yeah.
I don't like to do all that stuff, but I know what the benefits are. And I know when I'm running and I'm suffering through, maybe a longer run, and it's hot outside now.
Yeah.
My mind wants to take the easy way out. Like, dude, you can just walk this one. Or, man, you don't need that last mile or whatever, right?
Right.
That's what human beings do. And especially when it comes to stuff like this. Like, I don't have the time. There's too many activities going on, kids running around, work schedules, all this stuff. I know I probably should do a little bit more research and make potentially better decisions with my money. But, life events happen. But what do I have time to do? I can check things out, news on my phone, and I might, skim through some news. Right. Just so I have all the little tidbit headlines that people might ask me about at work. And all of those things add up to you making the same decisions as the quote-unquote smart money. And you guys are just flat out wrong. You flat out wrong. And I don't have all this information just hidden in a vault somewhere. And I'm like, I'm not going to give this to anybody. It's all out there for everybody. You have to be either willing to do one of two things. One, actually spend the time to look at what history would have to say. And there's this thing called the internet that allows that to happen way more efficiently. And you can just ask ChatGPT if you wanted to.
Yeah.
Right? Or you actually have the humility to say, my life is what it is. And I know that this is super important. And there actually are places like Shepherd Wealth Management that truly wants to surround somebody with all the resources, all the professionals, CPAs, estate planning attorneys, certified financial planners like myself, to do quarterly reviews with you, to give you all of their data and information and rationale, an easy, understandable format as to why we're doing what we're doing, what the performance expectations should be, and all of these things. There are places like this. I think that we're one of the few, certainly here in the Midwest and Cincinnati, Northern Kentucky region, that's willing to do all of these things for customers and charge that at one low price point. We're not adding extra cost to all this. It's just, this is the package. This is the service. Here's the expectations on both service and performance. And if you're down with that, and you have the humility to say, you know what, my life is what it is, and I actually could use and benefit from holistic financial planning and services, that's why we're in business. And that's the reason why we've had a lot of success in the last 2 years and growing. We've been in business for 2 years now as of Tuesday of this week.
When are we having that party?
Well, depending how the rest of the year shakes out, I'm pretty sure we can...
maybe August.
We can make that happen here. Yeah, we got some stuff going down this summer.
Yeah.
But I'm looking forward to doing a little client event where we all get to celebrate, as a team, Shepherd Wealth Management team, and our clients just saying, hey, we appreciate you guys, and, here's a round on us.
Yeah, I can't wait.
We'll definitely get into that. So those were the major points that we talked about in the seminar. And the last thing I kind of wanted to get into is, before we maybe answer any questions, I'm not sure where we're at on time here. Just keep me on
35 minutes.
Keep me on point here, buddy. We hear about the market just being like 7 stocks all year long. And
what do we call them?
the FANG. Yeah.
The Mangs, because it's Meta now.
Yeah. I mean, when they changed their name, it kind of jacked up that whole thing.
I like Mang better.
You like it better?
It's
kind of like FANG because,
it's like something you can sink your teeth into.
Not only that, but I was always a big fan of, those vampire movies, shows.
Oh, yeah. You want to watch Twilight any day of the week?
I don't know about Twilight, but,
oh, man,
The Walking Dead is cool.
Yeah.
I know they don't have vampires in that, but
zombies.
I like all that sort of stuff.
Yeah. I mean, grew up with that stuff, like Lost Boys.
Exactly. I digress.
Yeah.
But to answer the question, everybody's talking about, just really 7 stocks. The FANG stocks kind of lead the market. Yes, that has happened to some degree. First of all, if you're in the positions, who cares? Congratulations. You got performance. I don't care if you got performance from one company in your portfolio that made you produce a better result than the S&P, and you had 19 others that did terrible, but the one did so much better than everything else. Like, who cares? At the end of the day, you did a good job.
Yeah.
Right? And second of all, there is more broadening out in this market that's taking place right now. We call it breadth, meaning that there's more sectors and more companies participating and staying above, their 50 or 200-day moving average, whatever's potentially more important to you, depending on your outlook for the market and how, long you're potentially going to be invested in a position. So obviously FANG has done the heavy lifting. We just talked about that. But there are some laggards in FANG that I wanted to point out. So Amazon, even though it's had a phenomenal run this year, it's up like 45%, I think, it's still, trading below where it ultimately should be trading from a moving average perspective. So there's more room to run from Amazon. You could say the same thing about Meta. Now, their moving average got jacked up, last year when, the stock price got cut in half, and even worse than that, it was down like 70% at one point. So their moving average chart, if you look at it over a 12-month period, is jacked up. So they're definitely still trading well below, their long-term moving average. You could say the same thing about Netflix and Tesla as well. So even though FANG has had a great start, I just gave you 4 of the biggest companies in the S&P 500 and definitely in the tech-heavy NASDAQ that still are really trading below their long-term moving averages. So there's more room to run there. Russell 2000, small caps, been awful. 2022 was not a good year for small caps in any way, shape, or form. They didn't not get off to a good start this year either. And the main reason for that, there's 2 reasons. In these small cap companies, you're going to get a lot of regional banks in there, right? They're smaller. And there's 4,000 regional banks, so there's going to be a lot of exposure to regional banks in a small cap index. And the other reason why it really suffered last year and early parts of this year is because those smaller companies, like under $1 billion in most cases, they definitely need financing to operate, right? So when the cost of running your business is greater because interest rates went up 500 basis points in a very short period of time, it makes it extremely difficult for them to operate and keep their profit margins healthy. So that's the reason why small caps really haven't participated in the rally, but they are right now. Recently, we've seen yesterday or a couple of days ago, small caps were up 3% in one day. They're up 6% for the month so far, which is awesome to see them participating in the rally. I think that's a great place to be, specifically when we are looking at potential rate cuts. So it's definitely something that we're talking with clients about, saying, hey, we want to participate in this space. It's coming. It'll be a part of the rebalance that we want to do as far as taking out of tech and using some of that capital to invest in small caps and also industrials and energy, like we talked about, some of our other favorite sectors. Regional banks have been surging recently. That's also been a big boost to small caps. So the KRE, which is a index that tracks all regional banks, we have a short-term tactical trade that we put on. It's been something that we did for clients right at the peak of the regional banking crisis. That sector obviously, fell off a cliff, down 40, 50 plus %. We didn't quite pick the bottom, and I'm not ever trying to pick a bottom on anything. I understand it's, you basically are very fortunate, lucky if you actually do pick a bottom, but we got pretty dang close on the KRE. And that thing is up like 20% for the majority of our clients because we, again, kind of timed it fairly well. Again, that's a little bit of luck. You are looking at these moving average charts to kind of give you an indication of where's a good entry point. But the whole point would be like, hey, if all 4,000 of these regional banks are going to be in business and the Fed's not going to allow them to just collapse or get merged into some other bigger bank, then there's an opportunity here for us to take advantage of a 4 to 6 week trade. So we put that trade on 4 weeks ago as of today, and we're likely to exit that position, I'd say, in the coming days. Could happen today, I'm not sure. But that's a tactical trade that we're doing for a lot of our clients as well. And it's only about 1 to 2% of the overall portfolio. So certainly not betting the farm here by any means, just in case we were wrong. But in this case, it looks like we're pretty darn accurate. And the last thing that's been participating, and again, we talked about this at the beginning of the year when nobody else wanted tech. Tech killed it.
Tech's going to kill it.
Nobody wanted to be in industrials. Industrials are strengthening this breadth, this broadening of the market here as well, up 4% this month. And that is consistent with the historical precedent of when that PMI manufacturing index bottoms or it's below 50, like we talked about in previous podcasts. If you don't believe it, go to shepherdwm.com and go hit the YouTube channel.
Yep, they're all archived there.
Historically, when PMI, that manufacturing index, bottoms below 50, it's a great entry point historically. It's happened, I think, 12 other times in history going back to the 1950, and 12 of 12 times, 6 and 12-month games came after that low point of PMI being at 50 or below. So we've been talking about that for a while. That's now participating in this market rally. So you got tech, you got industrials, you got energy staying at a very attractive price level from a profitability standpoint because OPEC Plus announced production cuts. It's the travel season. You know, flights are booked. People are going to be driving around, going on vacation, all this stuff. So you're going to make some money, very likely, in energy over the summer months here. So what are we going to do with all this? We're going to rebalance the tech. We're going to move some to some small caps. We might put a little bit in these money markets that are still paying 5%. We'll probably put some to work in industrials and energy. And then probably, and we're going to do this again, obviously every 2 weeks we're here on the podcast, but later this summer, if I'm right and history repeats itself, we're going to have to do the opposite. We're going to sell some of the gains in industrials and in healthcare, come back maybe underweight on energy after we get out of the summer months, and pile a lot of that back into tech. If I'm right, you know, we still have a lot more room to run in tech as we just kind of laid out here.
Yeah.
We still are tracking towards that 47.50 price target that I have in my mind by the end of the year. And where's that mostly going to come from? It's going to come from tech. And at the end of the year, going into the fall, Q4, tech's going to do what it historically does. People start buying their goodies, you know, a lot of tech gadgets, buying stuff on Amazon, etc. So I'm very, very bullish, as you guys can tell, which is still the opposite of the consensus, the quote unquote smart money.
It's almost like people just got so frustrated that they bought so hard into it and they're kind of wrong that they're just going to double down, be like, screw it, I'm just going to keep pumping it. And then also still just so like hurt from the past 4 years.
Yeah.
And all the fear mongering that we had about the end of the world and it never showed up. And they're just like,
let me help you.
Cycle.
That's why I'm here, man.
Yeah.
If that's you, I am your guy.
I mean, you see it even in the social media for the Financial Shepherd podcast. Whenever you want to take a big dump on the future, everybody is like, oh yeah, you're so right. But whenever you point out the reality of the situation, people don't want to hear it.
Man, I'm here for you guys, man. It's just humility, right? Like, I can't even say the word I was early last year because it's my job to be the professional. Like, I should get handles on things. Now, we did outperform the market for the majority of clients in 2022. Obviously, it was a tough year, no doubt. But I shouldn't have had the weighting that I had in technology. Now, obviously, it worked out now.
Yeah.
Back then, it was extremely difficult to have a quarterly review with a client and say, yeah, we're still overweight tech because of all this historical precedent. It took a little while, and I was wrong to have that much of a weighting. I should have had a weighting in tech, just not as much. I should have had, and eventually what we ended up doing is having a massive overweighting in healthcare and energy last year.
Yeah.
And that's a big reason why we did, better than the overall market for pretty much everybody. That we had some extremely aggressive, much younger clients that wanted more tech exposure for obvious reasons when you have that kind of long-term time horizon. But for the bulk of folks, specifically the retirees, which is the average client here, did better than the overall market because of those decisions. But the reason why you keep that much money in tech in that circumstance, even though it was very difficult to have those quarterly review conversations, like why are we in tech when it's just getting slapped around, is if you look at those historical precedents, that's how you can make a case. And thankfully, we made the decision that we did with energy and healthcare because we sold those gains and really piled into tech when we felt like inflation had finally peaked, right? We saw enough months of data going from June of last year. And then the average bear market lasts about 9.5 months. Well, once we got to October and we hit that October 12th low, we now know it's a low.
Yeah.
But back then it's more of like, okay, history says this. That means this feels pretty good about making this decision from a probability standpoint, because there is no guarantees, in the business that I operate in here. But thankfully, we took the gains from energy, healthcare, piled into tech, and that's what really has put the significant outperformance for our clients, 5+ months into the year here. So I'm very, very pleased with all that. And again, folks, it's not because I'm the smartest guy in the room. I'm usually not, but I'm humble enough to understand what I need to understand to help people make better decisions with their overall portfolio from a financial standpoint. And I encourage you all to do the same, or work with somebody like us that would be happy to do that with you. So with that, I hope you guys really do enjoy your summer plans and travels. Do that safely, of course. I know that our family's looking forward to family vacation coming up in Michigan in a few weeks. So we'll do a podcast before that actually happens. That way we keep the 2 per month at a minimum going. I think that's all we got today, Ez, unless there's anything else that we need to wrap up with.
No, I just want to remind anyone who's reviewing this or watching this post the live broadcast that make sure that you pay attention to the schedule for our live podcast, and you can hop in the chat and ask any questions that you want. Joshua will answer them, pending legality and, what we know. But please, if you have finance questions or questions about investing, the market performance, NBA basketball, UFOs, there's another guy in the room.
Lucky Charms,
yeah,
we'll talk about that too.
Yeah, but please be ready with your questions. We love it when we get to engage with the viewers and even clients of SWM that catch the show.
100%. Don't forget shepherdwm.com takes you to everything, all the podcasts, YouTube videos, Spotify, our newsletters, our blogs. So I'll keep doing that just to support you guys. Love your questions.
LinkedIn profile.
100%. You can text us, call in 513-630-2664. I've had another great time here today, Ez, in studio.
Absolutely.
With that, I hope you guys have a great rest of your day.